Hi, everyone. I'm Rick Bensignor. Today is Tuesday, October 26th, and welcome to this week's In the Know Trader Show. On tap for this week in our trader education portion, we're going to kind of concentrate on know what you're trading. Our market overview, we'll look at the Dow Jones Industrials and the dollar index. And then in this week's sector analysis portion, we're going to look at some foreign exchange ETF contracts, as well as some cryptos. And of course, they're tied together, so that's why I've bunched them together. And that's what we've got going for the show. Just some house cleaning. Let's start off with, if you're interested in my weekly tactical trader report, generally comes out Thursday nights. Occasionally it's a Wednesday or a Friday, but almost always Thursdays. And it reviews a whole bunch of stuff across the macro space. So we'll look at bonds and gold and the dollar and credit spreads and the S&P in depth. Then you get a new ETF trading idea each week, and we review every open prior ETF trading idea until we close it out. Then we also publish a monthly 7-11 Spider Sector ETF report. The goal of this report is to outperform the S&P by being in no less than 5 or no more than 7 of the 11 Spider economic sector ETFs, meaning XLF, XLE, XLI, XLK, etc. And we started this August of 2020. After the first year, we outperformed the S&P by 261 basis points. And we are, since then, so in August and September of this year, we have outperformed to start off the year. And we'll take a look at the end of this week. It's the end of this month, so we'll update results for how we did in October, as well as give you proper allocations for November. And lastly, my email address is rick@intheknowtrader.com. Thank you for sending emails and continue to do so. I respond usually quite quickly to them, and usually give you the information you're looking for regarding the products we have. I feel like, one more thing related to all this is that we're still working on and updating a brand new In the Know Trader website. There is an issue with the current website on one of the pages, the services page. You can still sign up on the sign up page. And we're working on that to get the new totally rebuilt website out to you as soon as possible. All right, so that's it there. Let's just take a quick look at what's going on across the market sector-wise. The S&P is up 23% this year. That's on the far left from this performance chart from StockCharts. Notice energy is now up over 60% on the year. Financials are in second place at about 40%, real estate at 34%. The two major underperformers, utilities and staples, we've had no exposure in those sectors this year in the 7-11 report. You can see that pretty much everything to the left of energy is very much in line with the S&P, small variances from there, but all within a couple of hundred basis points of the S&P. So energy clearly has been the place. We upgraded energy in mid-August on the precise low of the move in relative terms, and have really picked up a significant alpha since then. We actually have this as a full double weight. So it's got the S&P Energy Index, if I recall, is only 2.5% of the S&P. We actually have it at about 6%. So a full double weighting, and that's how we've really captured a good amount of that excess return relative to the S&P. All right, so let's go back and kind of start things here in the sense of know what you're trading. So why are we going to concentrate on that? Well, there's so many different products out there these days to trade, tons of ETFs, obviously new ETFs coming all the time. And I specifically, thought of this in the sense of there's, the crypto space has become more and more popular. And over the last week or so, we saw Bitcoin make a new all-time high. We saw Ethereum make a new all-time high. People love this part of the market. And obviously, if you've invested in either of those two, I can't say for some of the other ones, but either of those two, if you'd be pretty hard pressed to have a losing trade on right now, because they're virtually, they're both within a few percent of all-time highs. But I specifically chose this because of the new ETF that started, I think it was last week. The ticker is BTIO, and it's this new ETF that tracks Bitcoin futures. And I want to go into some of the specifics here, in the sense that it is so important that if you're going to trade this new product, you truly understand what it is you're trading. So let's take a look at a few things that I've written down here about BTIO. Firstly, BTIO holds Bitcoin futures. It does not own any Bitcoin. This is hugely different than, let's say, if you bought GLD, which actually owns gold. This does not own any Bitcoin. It owns Bitcoin futures. Futures are an obligation to take delivery of a certain product at a time and a specific date in the future. But the contract itself is simply a piece of paper obligating you to take delivery if you're still long that contract at the time of expiration of the contract. So the bottom line here is that this BTIO new ETF does not hold any Bitcoin. It buys the front month futures contract for Bitcoin. So if you're going to buy BTIO, understand what it is that you're getting yourself into. You're not long Bitcoin. The contracts own no Bitcoin. They own Bitcoin futures. So if you're going to own and play the futures markets, which is essentially what you're doing, you need to understand some really important things about futures markets that are not necessarily applicable to any other type market. Foremost, the two terms of contango and backwardation. If you don't know what those are, you need to understand it, because it's going to dramatically affect the price of the futures contract and the forward futures contracts relative to the spot futures contract, and then the differential of the spot futures contract to the actual underlying market that the futures contract is set to track. So in this case, it's Bitcoin, and Bitcoin futures try to, emulate the price of Bitcoin, but there are nuances and reasons that they don't trade the same price. The two biggest things to understand is contango and backwardation. Contango is when each futures contract forward out, going down, the calendar, is priced higher than the one before it. So in other words, if the spot month for Bitcoin futures is right now, it's probably, I don't know if it's still an October contract. I think it probably goes to the last day of trading. But let's say that it is the October contract. There, in a contango market, the November contract is going to be priced higher than the October contract. The December contract is going to be priced higher than the November contract, and so on. Each subsequent contract is priced higher. That is what contango is. And that is the usual for futures markets, that the farther out you go in time, the higher the price contract. Occasionally futures markets go into backwardation, something that we've seen oil been in for months until just about yesterday, when they crushed the spreads and they're finally getting back to even money, meaning that when they're in backwardation, the front month contract, the most active contract, is actually priced higher than the next one. And the next one is priced even higher than the subsequent one, meaning, for instance, that November oil traded here in the US, the WTI contract is priced higher than December oil, and December oil is priced higher than January, and January is priced higher than February, and so on. That is backwardation. And that happens when there's supply issues and people need to get their hands on that particular commodity right now and will pay premium prices to get it. And that forces the front months to have higher prices than the back months. Why is this important? Because you are trading, if you trade BTIO, you're holding Bitcoin futures, or the ETF is holding Bitcoin futures. So you need to know how that's going to affect future prices. In a normal contango market, each month when the futures contract expires, the portfolio manager who runs the fund has to sell out of the current contract because they don't really want delivery. And Bitcoin futures aren't, you're not getting delivery of Bitcoin anyway. It's a cash settled contract. But they don't want to deal with that. So what they do is they'll sell out of the front month and then buy the next one and roll all that money into the next month. If you're in contango, the portfolio manager has to pay a higher price to buy that more expensive contract. So there's a loss every month as the portfolio manager rolls forward the contract to the next month. That becomes the active month. If the market's in backwardation, you're actually selling a higher price contract, and when you buy the next one, it's actually lower in price, and you make money on the roll. So it's really important to understand how those markets are priced and what's going to happen, because if it's in a normal contango market, there's a loss factor every month as the futures roll off the board, and the next spot month becomes the front month contract. So it's why there's a drag on price for an ETF that tracks futures markets, because there's almost always a contango market, and each roll costs money. There's a carrying cost, and you're always paying a higher price each month as the portfolio manager rolls, and therefore there's a drag on performance. You need to know this, because if you hear that Bitcoin is up 10% in a month, and you look at, let's say, something like BTIO, and it's only up 7.5% for the month, well, there's a reason. So you've got to understand this if you're going to trade any of these ETFs that are backed by futures. Secondly, unlike other commodity futures markets, Bitcoin itself has no intrinsic usage value. Corn futures, well, yeah, corn has value. You can eat it, you can give it to, you can feed your cattle with it. It's the main ingredient in God knows how many other products. There is something useful, and therefore corn, wheat, soybeans, cattle, cotton, they all have true intrinsic value because they are used as commodities. Bitcoin has no intrinsic value, and therefore it's got much less backing it than these other markets that are true commodities. And in the case of something like Bitcoin futures, the government is not going to step in and be there as buyer of last resort, whereas in a standard commodities market, there are checks and balances to make sure the integrity of the market stays whole, even when they crash. Even when oil went negative last year, it still was a function of the marketplace, and the market corrected itself very quickly, and we went from negative oil very quickly back to positive, and from sub $10 oil to the current $85 oil. No such thing is available on the Bitcoin side. So the ETF is tracking futures, but Bitcoin, again, is not something that's going to be stood behind by the government. Thirdly, it is supposedly unhackable, but we know almost everything gets hacked sooner or later. Look at how many places that, whether it's an insurance company or a Google email or who knows what, where you get an email saying, we're sorry, we've been hacked. We'll do everything we can to protect you. Bitcoin is supposedly unhackable, but we already saw the government get involved earlier this year, where they essentially hacked into it on one of the corporate espionage cases, and tried to return as much of the money as possible. So realize that you're dealing with a futures contract on something that has no intrinsic value and is not truly protected by the government. BTIO has an expense ratio of 95 basis points. It's almost 1%. That's pretty high, for ETFs. I'm not saying it's the highest out there, but just realize that you've got a decent expense related to this. Although generally crypto traders are more willing to have wider bid offer spreads than other markets, and some higher carrying costs. So this is not necessarily out of line to trading the crypto space, but you should know that you're giving up almost 1% every year. And that of course ends up being a major drag on performance. And what I would recommend you do is, for this or any other product you're going to trade, but especially if you're into this new BTIO, and there's one other one, there's a Valkyrie ETF that came out last week also. I think that ticker was BTF. Download, go to the website of the direct seller of the ETF, download the prospectus, read it carefully. Now, you hear that on commercials, you'll hear that often from places. This is one of the times that I think you really need to, so that you truly understand what you're getting yourself into, as well as the risks that are inherent in something like this. Because look, you're trading an ETF that's based on futures. The futures are based on coin. Coin is based on what? So non-intrinsic value. There's a lot of things that go wrong in a formula like. So if you're going to trade IO, know what you get yourself into. And that's all I have to say on that subject matter. Here's the Dow on a weekly chart. We've obviously pushed to new high. We are close to the high propulsion level we have here, which is at 35,962. Currently, we're at 35,088. We're only 100 points or so away from what we have here on a weekly chart as far as upside target. And try to look through. I'm going to take it off for a second, and then I'll put it back on. So, here's the basic chart. Take a look at how good the cloud gave you a sense of the bottoms in here, in that the baseline, which is this orange colored line, again, part of the cloud model, you had a close on it here, you had a close just beneath it here, then you shot back above both the conversion and baselines, and you've been on your way since. The pullback also held the most recent TDST line. That's a Tom DeMark indicator. That's the lowest low in the most recent 9 setup count, and that's exactly where we bottomed into before turning around, making new highs. Now, I've still been in the camp that we're going to go somewhat sideways into year's end, and obviously we've had a very strong last 4 weeks, and it wasn't a surprise to me that we'd make new highs, but I'm not convinced that we just keep storming to the upside. So I'm more in the camp that we're not going to go a heck of a lot higher from here. Of course, I certainly could be wrong, but that's the call that I'm sticking with right now, is that the S&P doesn't get much higher than 4,600, 4,650, kind of best case. And I still think there's a good chance that the same issues that were in place, just over a month ago when we sold off in the month of September, are still there now. There's a lot of things that are still unresolved. We're going into winter time. We're smack in the middle of fall. We're heading into winter time, where if COVID's going to get worse, it would get worse over the next several months. We still have employment issues, and interest rates are moving higher. There's still a fair amount of things that could contend from the market and kind of make us not progress a heck of a lot. But I do like where the market bottomed on the minor correction. I did tell you very clearly that I did not think there was any chance for a 15 to 20% decline. That 5 to 10% was possible, but that those mega bears, and there are lots of them on the street, were not going to be proven correct, and that the market was most likely going to kind of stall in and around, let's say 4,500 S&P plus or minus 150 points, and we're in that zone now, and again pushing new highs, but I'm not convinced that these highs are going to stick around. Let's look at the dollar index. And dollar index is hugely important for so many things. Get the dollar right, and you'll get the metals right. Obviously you get the currencies right, and if you, it has a big play on the kind of intermarket analysis that you get with interest rates and how much interest rates affect the dollar and so on. So to me, I'm always trying to get the dollar call correct, because if I can get that right, it materially helps me in lots of other markets. Here we go back to the spike high that took place in early 2020 when the market sold off, the dollar soared. So into the March 2020 low in stocks, the dollar made its peak, and then it sold off the rest of 2020 as stocks turned around and went higher. We've got a long-term kind of double bottom here, both the first week of January and then here in May, both testing underneath the 90 level in the dollar index, both accompanied by downside exhaustion 13 signals that we highlighted at the time. I've told you many a time that I came into this year bullish the dollar, whereas the street was very bearish the dollar. It was the largest macro consensus fall is that the dollar was going to go down this year. And you'll notice that the dollar didn't go down. It bottomed the first week of January, and it has been up over time. We're now getting and kind of stalling against some resistance, both from a major uptrend line, this blue one, which we had broken underneath in the fourth quarter of last year. We came back to it here earlier in the year. We came back a second time, and here we are again now a third time, kind of bucking up against this, as well as that the bottom of this blue shaded box is the 38% retracement relative back to the highs we saw in 2020. And you've got a fairly flat 200-week moving average in here. I've got a TDSD line, those dotted blue lines here. So where we hit R2, which to me was resistance 2. Initially in the year, I made the call that we would go up to R1. We eventually broke through that, and now I think this area here is fairly important. So it's against old highs from summer and late or early fall of last year. There's definitely some resistance here. The question is, are we going to get one final push to clean out all shorts who are still leaning against those old highs? Remember, the bulk of people who have been in the market this year in the dollar have been, the big players were negative the dollar, and they've had losing trades. Now, maybe they were smart enough to cover a bunch on this pullback here, but my guess is they were probably looking for this to break and go even further down. So there's still dollar shorts who are getting hurt, and we may have to see one final push kind of more into this Fibbo box in order to really knock them out. And I'd be more inclined in the 95 to probably 96.5 zone to be a seller of the dollar, especially because that's really where it broke down from also in 2020. So that's the dollar itself. And now let's just take a look at the list of different ways you can play the dollar. The first, we're going to start with UUP. UUP actually has more assets than any other foreign exchange related ETF, and it is a bullish biased ETF. So if you buy this, you buy it because you're bullish the dollar. And this does not track the dollar index. It tracks its own component dollar index, but not what we call the DXY, which is the most popularly looked at basis for the US dollar. But similar to the dollar index, we had 13 on this low. We had a weekly 13 close to this low here too. So it trades similarly. It's just not an exact one-for-one relationship, but this is going to line up similarly. You're going to have resistance up to about 25.5 from the current 25.22. So that's only about 1% higher from here. Now realize this, this is not a high flying type of instrument. The US dollar is relatively stable. Obviously it moves. This is not the type that you make a killing on. It is, to me, it's, these are trades and also just the basis behind understanding what the dollar is doing. So, and as it relates to other markets, FXE is the euro against the dollar. So as the dollar's been rallying, the euro pulls back. So the current price is just beneath 108. You can see support down here from unrelated things showing up just north of about 106 or so. So same thing, this is within 1% or 2% of a potential bottom. And it's unlikely, if I'm right about the dollar, it's unlikely going to take out the lows down here, which is 100 and change. So as it gets down, another 1% or 2%, I think about buying for a counter trend flip. FXF is the Swiss franc. And if you're a regular stock jockey, you're not generally looking at this, but there's plenty of people out there who trade foreign exchange, and they'll trade the actual cash market. But instead of setting up a foreign exchange account with a foreign exchange broker, you can trade the dollar against all these currencies simply through these ETFs. So FXF is the dollar versus the Swiss franc. It came down to the 200-week moving average here on a 9, and that was the bottom, shot up to a 9, and now you're in between, and you're just trading in between the 200-week and the 50-week right now. Not too much of a bias on this one, but you do have a real likelihood here for a double bottom against those lows. That's close enough to me to say double bottom. FXB is the British pound. Is not part of, as you all know, the British pound is not part of the euro currency or the European Union. So they always stuck with their own British pounds. They decided not to be a part of that. And here you are finding some support in the British pound against the top of the cloud. You got one move down here to the propulsion level, which it rejected. So I give a little bias here, bullish on the British pound. Let me skip, because we're running out of time. Let me skip ahead to Bitcoin. This chart is actually a chart I use with my institutional clients. And I had noticed that it took often 3 different sequential or sister combo signals before you actually got the real turn. He said upside exhaustion. It took 3 to get downside exhaustion. We had 2 here in early October. We made the new highs, got the 3rd one, and right away we've come off. So not hard, but we're still beneath what were the all-time highs right now. So it's very iffy whether or not this breakout to new highs means anything. To me, it's more of a short than a long. But obviously the path of least resistance for Bitcoin is higher. And then Ethernet looks Ethernet futures did not make a new all-time high. Looks like it tied price from May, 13, 13, 13, and 9. So also getting a sense that this could be a real stall area, but notice that the cloud held here on the pullback. So I don't have a directional bias right now. Breakout above 4,500, it's probably, or actually I'd say breakout above 46.18, and then you have a better chance for a move higher. Otherwise, 37.25-ish or so is where the important support would be. That is it for this week. I hope you enjoyed the show. I'm Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.